Hi, this is Shankar and I welcome you all for the yet another edition of Bull's Card. As mentioned in my earlier video, while I was explaining about the capital gains taxation in India, today we are going to give you some insights on how the capital gains taxation is computed by the tax authorities. Capital gains taxation is calculated based on a method called FIFO. So what does this FIFO stands for? It is first in, first out, which means it's an asset management method in which the assets acquired first are sold first. I will clearly explain to you with an example. So let us assume that we are buying 30 quantities of Infosys at 1500 rupees and the stock prices goes down to 1400, where you are again buying 30 shares and averaging it. The stock then goes to 1450 and you sell that 30 quantity. You assume that you have sold the shares which you bought at 1400 and made a profit of 50 per share. However, in the accounting as per FIFO method, you are actually at a loss of 50 per share. It is considered that you have sold the shares which you initially bought at 1500 rupees. Since FIFO is easier to compute and more widely accepted, it's a more popular accounting and bookkeeping method compared to LIFO, that is last in, first out. It is just the opposite method of FIFO computation. But what is the major downside of FIFO calculation? The FIFO method might underestimate the cost of goods sold. We will just take the previous example itself. When you initially purchased Infosys first tranche at 1500 and the second tranche you purchased at 1500, and when you sold at 1450, actually the first tranche and the sales is match, which means you have incurred, as per the tax book, you have incurred 50 rupees loss. But just imagine a situation when the Infosys prices further increases and when it touches 1600, what happens here is that as per the accounting, the 1400 rupees purchase is sold at 1600. So when you subtract a lower cost of goods sold from your revenue, you have a higher gross profit and higher profits can increase your taxes. Hope I am able to give you some insights with regards to the FIFO method of calculation for capital gains taxation. So now we are also adding a content which most of you would be wondering how to go about. That is the taxation on dividend income. Now let us see how dividends are taxed in India. Many individuals earn money from a number of sources besides their job or self-employment, and one such common source of income is the dividend from equity investments or mutual funds. The provision on tax on dividend income went through a major change with the introduction of the Finance Act 2020. As per the Finance Act 2020, it has abolished the dividend distribution tax, that is the DDT, and transferred the tax liability from the dividend paying company to the investor holding the shares, or rather investor receiving the dividend. So besides changing the taxation method, the Finance Act 2020 also added a few new provisions on the taxability of dividend income. So as per the Act, a TDS is imposed on the dividends paid by companies and mutual funds on or after April 1st, 2020. The TDS on dividends of rupees 5,000 or more paid by companies and mutual funds is normally 10%. The TDS will be charged on the entire dividend amount, and additionally the rupees 5,000 threshold is applicable only if the individual shareholder provides PAN. Otherwise the TDS rate will be 20%. For resident individuals, the TDS deducted will be available as a credit from the taxpayer's total tax liability while filing ITR. For non-resident Indians, the TDS rate applicable is 20% and is also subject to its double taxation avoidance agreement, if any. The NRI can also avail the lower tax deduction benefits owing to any favorable treaty with the country of residence. However, to enjoy so, they need to produce documentary evidences like Form 10F or beneficiary ownership declarations or tax residency certificate, etc. Otherwise, a higher TDS would be deducted on the dividend which the shareholder can claim at the time of filing ITR. There is also no deduction of TDS applicable for those individuals who are having an annual income less than the exemption limit, and they need to furnish and file Form 15G and Form 15H to the dividend paying company. Therefore, please note that the proper knowledge of dividend income and its tax liabilities allows you to pay your taxes and claim maximum benefits. It is important to know all the rules relating to capital gains taxation, FIFO method, taxation on dividend income, so that you can manage your investments and expenses in a better manner. I believe I was able to cover the topic completely and hope you got some information with regards to the FIFO method as well as the dividend taxations. If you feel the content is informative, then please do like my video. We will meet in our next video soon. Thanks for watching.
As the markets are likely to bottom out, it's time to gradually enter the market in a staggered manner. To help you with analyzing the stocks, we will be covering on how to do research to succeed in long-term investments.